And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland Certified Financial Planning Professional Tim Stearns, CFP, and he helps you construct the Protect and Grow plan for your financial future, ladies and gentlemen, the written plan that you can have in your hands to help you make your way to and through retirement confidently. And Tim, we always appreciate the time you have here on the program and share with us. And I know that you strive. One of the top goals there at TJ Stearns is to have your clients more confident through a better understanding and education of where they are putting their money.
Yeah, Peter, we have such a vast world nowadays. I mean, go 30, 40 years ago, people were kind of nibbling on getting into mutual funds. They're only owning stocks, if they even had that. And that was through a great uncle that bought a stock 15 years before that, right? So nowadays, I mean, we've got some savvy investors out there, but I also don't think the quote unquote savvy investor, just by being on the internet, really knows what's baked into each area. And we have so many choices. I think we should kind of dig into these a little bit and kind of give a high level definition of where our money can be.
Yeah. Banks, brokerage accounts, stocks, bonds, mutual funds, ETFs, annuities. There's so much noise out there, so many different choices and options of where to place your money. Ladies and gentlemen, you've worked hard for it. You want it to do the best things for you. You need to understand the options that you have for utilizing those dollars and investing them for your future goals, which, by the way, you also need to have a plan that helps you to identify those goals and will then narrow down the choices of what tools are appropriate to help you achieve and accomplish them. That is the goal of having that plan in place. And that is why Tim Stearns and the team from TJ Stearns Inc. do offer to help you construct and put together and implement your Protect and Grow plan. The Protect and Grow planning process is a complimentary service, no cost, no obligation, to get a written plan in your hands for your financial future. And it covers income and investments, taxes, healthcare, legacy from a high level there, and helps you to feel more confident that you are selecting or considering the right choices for where to place and deploy your money. And we'll talk a little bit more about that during the course of the program. But if you would like to have a conversation with Tim and the team from TJ Stearns Inc., if you would like to get that Protect and Grow plan, if you would like a copy of the book, Solving the Modern Retirement Riddle, a lot of options and opportunities available on the table today, just pick up the phone and be in touch. That's your first step with TJ Stearns Inc. 800-640-2256. That's 800-640-2256. 800-640-2256. So Tim, let's kind of start at the beginning. When we first start earning some money or have some in our hand, or maybe if we need to have some in our hand, the first place a lot of us go and an institution, a location that will probably stick with us during the course of our financial lifetime's progress are banks. We know banks are on every corner. It seems like they're out there everywhere. Why are there uses and utilizations for the banks? And then when maybe are banks not the most appropriate option?
Well, a lot of people are talking to us right now about CDs with rates being the highest they've been in forever that I can remember. So CDs are looking good. They're going out 10, maybe even a year now. The only issue I'll say to that is that you're locking your money up. If the market goes on a roll, which if they start cutting interest rates this year, that will most likely happen, then you will be playing the shoulda, coulda, woulda. We had a woman in just the other day who had talked to me about doing a CD last year, and she made over 18% with us, and she's 83 years old. So I wasn't getting crazy with her money by any stretch. And she was glad that, we had done 5 times better than what her interest rates were going to be on a CD. But it's a good spot for some money, a little bit of it. I wouldn't put all my eggs in one basket of any of these things we'll talk about today. But that would be the one thing I would say is that, the bank, it's not real liquid if you're in a CD. If you break it, you're going to have to get back some of that interest.
Well, we do need to understand, though, Tim, that the purpose of the banks, really the top 2 priorities, is that we know our money is there and theoretically we can get our hands on it when and if we need it in very short order, right? Safety and liquidity, the 2 top goals for and reasons why we would consider utilizing banks. But growth is not typically one of the top qualities in keeping your money at the bank, right?
Well, in my career, this is the first time I've actually thought about having my clients do that because interest rates for the last, gosh, 12 to 15 years have been so low. My mother, who was really good at laddering CDs and that type of thing, had gotten away from that. Now we're revisiting it. So to your point, yeah, it's a place to go get cash quickly, and that type of thing, but beyond that, I like other vehicles.
Well, Tim, there is a FDIC calculator available online. You can look up how much money is in deposit in banks by zip code. And in the 60004 zip code, $2.34 trillion in FDIC insured bank accounts. That's a lot of money that potentially is not keeping up with inflation or
Right.
growing as much as it possibly could, right?
Right. Inflation, is around 3.10%. Uh, you know, that's really, I mean, you can beat it right now, but again, the market goes on a roll. You might want to look at other vehicles to put some other money at to work so that you can stay ahead of that inflation.
And we do need to also consider that they are not nonprofits. The banks themselves are looking to turn that money around. Just holding it in the vault is not what they do. They actually redeploy it and make money off of our money. Plus, in 2022, over $6.4 billion in ATM fees and overdraft fees. So the checking, the savings, the CDs, the money markets, ladies and gentlemen, may be a good place to begin your financial progress, but ultimately not the end all be all. So, Tim, if we want our money to do a little bit more for us, we turn to other options. And typically we hear an awful lot about the market, stocks, bonds, and mutual funds. Can we dive into some of those other tools and options?
Well, let's take a look at bonds. They've been beat up the last couple of years. In 2021, they did negative 1%. 2022, they were down 13%. Last year was a rough year as well. So, with them talking about cutting interest rates, remember, it's an inverse relationship. So when they cut interest rates, bond values actually go up. Adversely, when they were raising the Fed, raising interest rates, bond values were going down, as I just talked about those numbers. So bonds are might be a decent area this year. I know we are putting our toes in the water there. Not a lot just yet because we're still waiting on the Fed's signals to come, which are mixed at best sometimes. So bonds are definitely something we're looking at for this year, but it is usually a safer place than, let's say, equities.
Yeah, but Tim, a lot of people utilized bonds because they were toward the lower end of the risk spectrum, right? That they
Yes.
were considered more conservative, and we've seen that they not only are not safe, but probably are paying a little lower than some other options might in terms of income and growth, right?
That is totally correct. When I first got in the industry 30 years ago this May, the flight to safety was always bonds because they're basically uncorrelated to the stock market. And nowadays, you see as the stock market goes, so do the bonds, which is kind of a scary parameter. So, to your point, yes, there's annuities paying out better than that are safer, and then have mortality credits, which we can talk about a different time. But these are things that, we have people come in here left and right asking us, all right, if a bond isn't safe for me, what is a good fixed income alternative? And we definitely tell them about annuities. Fixed equity indexed annuities are something that we look at for that type of a client.
Well, we do want to get into annuities. That is one of the options that we have for our money, and one that we actually hear a whole lot of discussion and debate about. So we'll check in with annuities. But Tim, the bond market actually is much larger than the stock market, but generally isn't as exciting. So we don't hear as much about it in the news media. But there's municipal bonds with government entities. There's corporate bonds with corporations, and the bond side of the equation is one that is utilized in a lot of different capacities, especially inside of more conservative portfolios or fixed income portfolios, as we've talked about. So now let's move on, though, to stocks and the stock market. Tim, we hear much more about them because they tend to be more exciting. It's more captivating news, right?
Yep. Yeah, as you want to captivate, how about the Magnificent Seven's performance last year, right? So you have the seven stocks that basically propped up the S&P 500, your Facebook, Apple, Amazon, Alphabet, Netflix, Google, Tesla. And the best of the best is they say NVIDIA. I'm not recommending that. I'm just saying that's what all we hear about is NVIDIA with the AI exposure that's out there. And those are kind of the hot stocks right now. So if you didn't own those last year wasn't that great of a year, but they are flashy. These same stocks I just spoke of, some of them were down 50% in 2022. So
Right.
be careful what you wish for, because if you had really truly invested in them, you're about even from the year previous.
Yeah,
So, and
can be
that's
a wild ride in the stock market sometimes, and we tend to have like recency bias where we're only hearing the latest news. We're not putting things in perspective in that way, right, Tim?
right. We absolutely suppress our bad memories, and those are 2022. Those were terrible memories for clients that have come in here talking to us about their portfolios, and now they're what I'm seeing with a lot of 60-year-olds and up baby boomers is they want to get off the ride. The stock market ride is absolutely too wild for them at this point in their careers. 2008 wasn't that long ago, and we talk about this in our workshops and our classes that the good news is in 2008 you were a lot younger, but now as you're winding down your careers and that type of thing, you can't have these huge peaks and then these huge valleys in your portfolio because you're not funding it anymore. You're literally a net seller of assets, and with that you need to smooth out those valleys and peaks and make it so that it's about income. We talked about this a couple of weeks ago, Peter, but it's really about what your portfolio can throw off as income because you need to pay your bills. It's not that you have a high flyer in a stock that's going to pay the bills, because the next year it might be, down in the dumps like we just saw.
Although, Tim, as we are buying stocks, we are taking an ownership stake. We are actually owning that company. And so we hope that the value of the company rises, the share price, right? It can
Yep.
fluctuate, it can go up and down, but we hope that it rises when we buy in. And as owners, we also may be entitled to some of the profits of the company along the way. So some companies actually pay off income in the form of dividends. This can be a useful part in a portfolio. Now, as I understand it, Tim, that ownership stake is not the same when we invest in mutual funds. Now, with a mutual fund, we're not in one specific individual company. We have diversified, but we are also not specific owners of the companies. We are just participating in the mutual fund.
Right. It's we're getting fractions of shares of companies, and the good news is that you have exposure to that, and that got hot in the '90s, and now it's definitely something. Although it's becoming a little bit passe because people are starting to figure out something about mutual funds, and that is in 2022 when their mutual fund was down, they still got 1099s as if they had made money because people were redeeming it. It's different portions of it, and therefore you get a 1099 for a stock that you probably didn't own for very long and you had no profit from. So it's almost like a phantom income grab. So people aren't real hot for that. The other thing I don't like about mutual funds is that they aren't quick to change with the market. 80 cents on a dollar has to stay invested. Don't get me wrong, you can definitely call them and tell them to put you in cash, but I always ask this in workshops and our classes. Did anyone in 2022 get an outbound phone call that told them to go to cash from their mutual fund? And everyone looks at each other like, did you get one? I didn't get one. No one ever does. Right. So I kind of wonder about who's really at the steering wheel for that. They do well in an up market and they do poorly in a bad market. What's the difference? That you'd want to get into something that has stop losses and more organized money management that's active and tactical.
Again, we are talking with Tim Stearns, CFP. We are overviewing some of the available investment options on today's program. But if you would like to be better informed and educated and knowledgeable about the investment options that you are utilizing or that are available to you, and you'd like a plan to bring them together to figure out when and where each one is appropriate and why, pick up the phone and give Tim Stearns, CFP, and TJ Stearns Inc. a call, 800-640-2256. That's 800-640-2256. 800-640-2256 is the number. You can also go online, tjstearns.com, tjstearns.com. I want to circle back to that tax inefficiency for a moment, Tim, because one of the most commonly utilized investment options that the majority of Americans have available to them is the 401k. right? We use the 401k to save toward retirement, and in general, the 401k itself then in turn utilizes those mutual funds. Now, we're not going to experience that tax inefficiency quality inside of the 401k because we've got some shelter there. But when people invest money that is not specifically earmarked for retirement, because we can invest as much as we want outside of retirement accounts, right? But at that time, if we are doing that, then we really may want to consider the benefits, the merits, the potential tax implications of utilizing mutual funds. It sounds like, right?
Well, definitely. I mean, that's something to keep in mind. Mutual funds aren't the worst thing in the world. I like people being invested for the sake of it's for savings and it's pushing you towards retirement. But, again, as we said, it can be inefficient when it's in a non-qualified arena, which is, just a slush fund that you might have with your wife. That's why we are a little bit more appropriately putting clients in ETFs and that type of thing, that we can put stop losses, have active management, that type of thing.
Well, again, if you want to make sure that you are informed of the qualities of the investment that you are choosing, the investment option, the pros, the cons, the benefits, the disadvantages, ladies and gentlemen, and there are some to every option that is out there that are worth educating yourself on before utilizing them and deploying your money, then contact an experienced qualified professional. And Tim Stearns, CFP, your certified financial planning professional, is Chicagoland's proactive planning resource, home of the Protect and Grow plan there at TJ Stearns Inc. And to bring everything together, to get that plan in place, all you need to do is pick up the phone now, give a call, get the conversation started. 800-640-2256. That's 800-640-2256. We have a lot of people who call and just lock that in. They say, hey, I'm on the road, I'm traveling, I'll call you back later, leave a short message, but get in touch. Lock that number in, ladies and gentlemen. 800-640-2256. 800-640-2256 is the number to call. So Tim, one of the, we'll say, newer options that sort of compares to mutual funds are exchange traded funds. Now, they do not have this tax inefficient quality. That's maybe why they are picking up in popularity, right?
Oh yeah, everyone and their sister is getting into it. I mean, you see Vanguard has a new ETF about every 5 minutes. So they're seeing the writing on the wall. Vanguard, that also used to be a buy and hold company, is also buying companies that are actively managing through ETFs. So that is the way of the new world, is doing active tactical management. So I like ETFs for that matter, and so does Vanguard. So I think that says something, because as they go, most of the other companies follow. They're kind of the first alpha dog in that area. So we use ETFs extensively. We don't use a lot of mutual funds here.
Well, again, if you would like to evaluate all the options that are available and figure out when and where and why a particular one is appropriate or inappropriate for your situation, or where maybe you could have some improvement with your money, pick up the phone, give Tim Stearns, CFP, a call. 800-640-2256. 800-640-2256. Now, Tim, in the conversations of some of the other options, you have brought up and made some comparisons to annuities. Now, these are widely discussed and debated. What do we need to know about annuities, especially if we are own one or are considering owning one?
Okay, really simply, all annuities are not bad, and not all annuities are good. So, there's one size doesn't fit all. They definitely serve a purpose. We use them a lot with income allocation if a client doesn't have a pension, or if they want to have something like a dividend producing stock that's going to throw off an income that they can rely on, an income that they don't want to have to dig into a portfolio that they might have housed somewhere else. Dig into it when the market is down, for example. They know that their bills are being paid by the annuity every month, however they want that to look. So we will utilize them in an income allocation plan. But again, we also have clients that don't like annuities, and that's fine. There are dividend, we have a great fund that throws off 6% a year in dividends, but again, that's not guaranteed like an annuity would be. And so we have to, you march down the path, and at the fork in the road, you need to make a decision which side you want to go on. But for me, fixed index annuities, full disclosure, I own them. I don't have a pension and I need to set myself up for a pension. It also came with some, long-term care components in it too. If I can't do two of my activities of daily living, I thought that was good as well. But again, to my point, they are good, but they don't, one size does not fit all.
Well, again, if you would like to look at the pros, the cons, the benefits, the disadvantages, if you own any of these options, if you like a better understanding, if you are considering any of the options to deploy your money, anywhere from banks to brokerage firms to stocks, bonds, mutual funds, annuities, there are plenty of different options out there. But Tim Stearns, CFP, Certified Financial Planning Professional, can help you weigh those choices and options, help you make sure you're informed about the pros, the cons, the qualities, the benefits, the disadvantages. That is the help and assistance of an experienced, qualified professional with a certified financial planning professional, ladies and gentlemen, and why Tim Stearns' service to proactive Chicagoland area savers and investors is so valuable. If you'd like to get started and formulate your protect and grow plan, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. And just within each one of these categories, Tim, stocks, mutual funds, ETFs, annuities, there are a lot of subcategories within each one. So it's not like we're getting into all of the details. This is just a high level discussion. However, maybe one discussion is as important as any other consideration, possibly even more, and that is the tax status of the investment. Whenever we put money away, we have some choices and options as to how to qualify the tax status of our dollars. And that is something that you always encourage your clients and help them work through that consideration of.
Well, one of the things we've been doing in our workshops and our classes is I literally start off with, asking them some questions like, what is the number one asset that you have, the biggest asset you have besides your house? And most of them say right off the bat, my 401k/IRAs. Okay, great. Do you have to pay taxes on them? Yes. And then in my third question follow up, what is your tax bill? And you see the lights are on, but no one's home. No one knows that answer. So we all know we have a tax bill out there, but none of us realize how much the taxes are. And so what we do for people in our workshops and our classes is that we'll tell them, we will figure out that tax bill with you. It won't be specific to the penny, but we'll give you an idea because no one has any clue. They don't know that they have to do RMDs nowadays at 73. They know it's somewhere around in their 70s, but they're not sure. They don't realize that there's, risk, reinsurance risk when you're putting the money back in, where you have, taxes on that as well, right? And then the last one is that, with the Secure Act, your family is going, or whoever you're leaving your money to within 10 years will have to drain those accounts, and pay all the taxes on it. What are those three taxes added up to? They don't know that, and we help them get through it. So if you're out there and you're wondering, what is my tax bill? And you want to get it down to understanding it in a nice report, give us a call and we'll get you that in email, or you can come in and we can go over it with you. But we've done that for so many people because I think that's really lacking out there, and people are thirsty to know, what is my tax bill in retirement?
An eye-opening report, ladies and gentlemen. Basically, you put in your specific information, your age, the balance of your tax-deferred account. You talk about some assumptions that you may want to consider. What is the rate of return that you want to project out into the future? What is the rate of inflation? What is your income tax bracket rate? Right, all of those things. You put in the numbers in. Insert the data. Tim Stearns has these tools and calculators available, and the report generates out two sides of the ledger. If you defer and default to the IRS's plan, if you continue deferring your tax bill in 401ks or IRAs, or if you get proactive today, and the difference in the bottom line, the bill that you will pay in taxes over the course of your lifetime and beyond is staggering. I think every saver and investor needs to see this report, Tim. And I also want to put a caveat on that in that report, the numbers that are generated, Tim, that is as tax laws stand today as tax rates are currently, right? And the other factor of these tax deferred accounts is as long as the dollars stay over there in the IRA or the 401k deferring and delaying, they are subject to changes in tax law. So maybe that's why people don't know what they'll end up paying, is because we don't know what tax rates might be into the future. And a lot of people think they're going up.
I've never had anyone in a client meeting or a workshop or any classes say that the taxes are going down. So, the meter's running. You might want to figure that out sooner than later, because right now it'd be a great time for Roth conversions this year and next year. After that, all bets are off as to where taxes are going. I think they're going up.
Well, we are in control of certain elements of our money and finance. We certainly don't control the market. We as individuals certainly don't control the tax environment, but we can control when and how we utilize certain investment options, and we can control the tax status of our dollars. So there is controlling the tax bill, ladies and gentlemen, and there's controlling what you are utilizing for your money to help you achieve your financial goals. And there's also controlling whether or not you have a plan in place to help you determine if and how you are making progress toward those goals. That's what the Protect and Grow plan is all about. And as the name indicates, it's aimed to help you protect your money and grow your money. That is the goal of the plan, but the goals within the plan are yours. They are specific, they are customized to you. It is a written document that you get to take home with you, the Protect and Grow plan. And if you'd like to get that put in place, there's no cost, there's no obligation. It is a complimentary service that is offered as an extension of the education that we provide, that Tim Stern, CFP, provides weekly here on the program. So pick up the phone, give a call, get that process started, ask any questions that you have on your mind, and see what the Protect and Grow plan can help you identify for risks, issues, and opportunities from income, investments, taxes, healthcare, legacy. All you need to do is pick up the phone, give a call, 800-640-2256. That's 800-640-2256. 800-640-2256. And Tim, we always appreciate having you here on the program. You are always such a valuable resource to us, the listeners, and to those Chicagoland area savers and investors taking their planning and their financial future seriously.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stern's full radio program and visit tjsterns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.